Well, first of all, we'd like to welcome everybody to the July 16th Wednesday market outlook for strategy asset managers. And as you can see, Joe Traba and Alex Hagstrom are with us today. We are going to cover a lot of interesting topics that are at the top of the mind for all of us. One of the things that we're going to make sure that we do is get a grasp on the tariff updates and what's happening geopolitically. We're also going to talk about the U.S. dollar and its weakness and banking deregulation. Joe is going to touch base on the market recovery that we experienced during the first and second quarter. And then lastly, we'll make some comments on the one big beautiful bill. But as everybody has heard us in the past several weeks, if you've caught any of our commentary, Joe has been outstanding with the support of Alex in driving what we would say is impressive performance of the strategy asset managers' portfolio strategies. And we will explore the factors that have propelled the stock markets to record highs. So I'm going to turn it over to Joe, but I'm Tom Hulick, if you don't know, and I'm the CEO of Strategy Asset Managers, and welcome today.
Thank you, Tom. And again, as we do with all of our calls, as we look forward, I like to look backwards. And if you didn't look at your statements from December 31st to June 30th, you would think, oh, the markets did fairly well and nothing really happened. Well, we saw a complete V-shaped recovery during the year, which happened in the second quarter. And that rally was a 20% rally. And one thing from speaking with clients is to really not let emotions get the best of you. And as we've seen, when we make emotional decisions, sometimes they're not the best to be made. And what we've seen in the first half of the year, there were a lot of uncertainties. And if you were using that as your emotion to take the opportunity to sell, you might have missed this bounce. So that's the biggest point we'd like to make, is to not get driven and emotional with a lot of the headlines that are being out there. And what we'll hope to do is to share with you why the market did well in the first half and what are the keys for the second half of the year, but also for 2026. So we want to first go over some of the key points that helped the first half of this year and the market's performance. As we get into this, these are some optimism that's here, and I want people to really understand that. You did have earnings continue to grow, and we'll get into each of these points as soon as I get over all of the top points. We also did mention, how did this, with the tariffs, with the US dollar weakness, affect multinationals and also the foreign markets? We'll obviously touch on the tariff fears. Were they overblown? Why didn't the market sell off on this? And also the geopolitical risks, specifically the oil risk, and how that did not materialize. And again, do we expect the foreign markets to outperform on a currency and a non-currency basis? So those will be addressed. And also, again, the keys for the second half. Do we continue to see earnings growth happen? And where are the pockets of growth coming from? Also, the employment data, as one stronghold that we've been resilient on, is when you have strong employment data, you don't get deep recessions. And again, people are remaining employed and, most importantly, continuing to spend. And again, like Tom mentioned, the budget deficit or the budget bill that was passed. You know, for us, that means more government spending, and also a little bit when we look at taxes, getting them not heading higher. So there's a lot that was in play in the first half of the year. And we'll go over to why the market was able to recover. And again, some of the key points we're looking for the second half. And again, you hired strategy asset managers to not get emotional and make decisions that are affecting the stock market, not what the economy is doing, but what the stock market is doing. And there's been a couple of big themes that we think will continue. And one of those themes, we'll get into details on it, is power. And power meaning how electricity is generated and the infrastructure build out, not just in the United States, but in the rest of the world. And I think the other one that isn't getting as much attention, but it's really the effects from the GL1 drugs. And again, that's Eli Lilly is the stock that a lot of us own in our portfolios, but it's what you do not own, I think, is just as important. And what I mean by that, it's if people are getting healthier, they're not going to be eating as much junk food. And when we're seeing that play out, it's also when you go shopping, the middle aisle, those are low margin. Think of canned foods and more processed stuff. That, again, doesn't have margin play in it as well. And again, people getting out. So I think there are some positives that we see leading forward. And again, there are definitely risks that we're going to pay attention to. And Alex is going to share with us one of the reasons that I think this might be hard for people to understand, but the currency effect on the international markets, and more importantly, multinationals on how earnings are able to grow when you do have a weaker dollar. Alex?
Yeah, so a dollar decline is actually positive for earnings for the S&P 500. And the reason for that is these companies are essentially all multinationals. They get about half of their revenues from overseas. So when the dollar declines, those overseas earnings become more valuable to them. And so that in and of itself does end up being beneficial for earnings for the S&P 500. Now, smaller stocks are different. Smaller stocks do suffer from a declining dollar. But overall, I think, everyone should know that dollar strength and weakness is cyclical. The dollar has been gyrating up and down for 50 years. It doesn't mean that America is declining and America is not going to be the reserve currency. These currency fluctuations are completely normal and nothing to panic about.
Yeah, and that's a big point to be made. It's also when you look at the price of oil, and this is getting into our next concern, was geopolitical. And again, looking at you had a one-day spike on oil, but the prices of oil has gone lower throughout the first half of the year. And when you have lower oil prices, it's twofold. One, it does help the consumer because we are spending less at the pump, but it also, the US dollar, oil is priced in dollars. So that's another reason why you've seen a little bit of weakness in the dollar. And the third point, it also helps with our budget deficit. And I think that we'll get into this with interest rates. Having a weaker dollar, how that helps lower our budget deficit. But again, the tariff fears that we've seen and the geopolitical risks that happened in the first half of the year, why the markets did not go into a deep recession or an overblown. I think a lot of, again, this is what the stock market does. It's going to look forward. And when we hear these headlines, you sometimes have to take a step back and go, okay, what is the effect for the stock market going forward? And so far, what we've seen, the tariffs have not been this big tax on the consumer so far. And again, a little bit of this has been off and on again. And also with the geopolitical risks, meaning that we did not see a big spike in oil or a big decrease yet in US consumption. So again, the headline news that may get overblown, we want to make sure that we more have a dialed back attitude and look at this from a fundamental outlook and what's changing. And again, the risks that are out there, we do continue to remain. They have not gone away, but people are still employed, and that's our number one catalyst. And I like to do these, Tom hears this all the time, the what if scenarios. And we know with AI, anyone that's been using it, that continues to grow, and it's going to grow across the world. This is not something that's just going to end. But don't think just AI, think of the data center growth that needs to happen. And I really think of Pennsylvania and Ohio. These areas just have massive growth because they have new data centers growing there. Not right now manufacturing plants or farming, but it's these giant data centers that are happening. And that takes a tremendous amount of energy. And also you need a higher worker there, more skilled worker. So part of our optimism when we look at next year is that we do see this power continuing, and also looking at job workers coming back. And that's going to be a displacement from some categories, but also a boon for other places. So these are the kind of the negatives and positives when we look at the risks associated with employment and AI. And Alex has done a good job when we talk about employment, but looking at some of the bigger challenges to employment with AI. Alex?
Well, yeah, I mean, look, we're certainly seeing AI related layoffs, especially from the large tech companies. But you see this whenever there's a technological transition. Obviously, when farming became automated, a lot of farmers lost their jobs, but they moved to the city and became factory workers. Ultimately, while there is going to be a lot of friction, certain jobs are going to go away. New jobs are going to be created, and America, being the epicenter, is likely to get the greatest benefit from those new jobs. Joe mentioned data centers. There's more data centers here than in the rest of the world combined, basically. So while there will be negative headlines and there will be people losing their jobs, there will be new jobs created, potentially better jobs than were lost.
Joe, let's talk about some of the sectors that we're focusing on for the second half of the year that's going to fuel the growth of the portfolios from here on.
Yeah, and this is an interesting point. We do this a lot. Is being in the right sectors is sometimes the best, being best place to be than the best stocks. But the two big differences is we are still underweight technology relative to the S&P, and with our quant fund that just gets rebalanced twice a year, momentum has been a huge driver of outperformance this year. And the two biggest areas are the underweight in technology and the overweight in utilities. Now, some of you may be confused, well, technology's done so well. Well, it's a couple of the mega cap tech stocks that have done most of the lifting. Not all of technology has done well. So that's one big takeaway, but it's also utilities. And you think of utilities, well, why would a traditional utility company do well? It's the nuclear power that's done exceptionally well, and that trades into the whole sector. So those are the two big takeaways. On another point, financials. And I'm mentioning that because right now earnings season has just kicked off for the quarter, and you've had the multinational, the big banks and some of the investment lending banks report earnings, and they were really good. So we do have earnings growth from financials. And some of you may know, I don't need banks or financials to lead the markets, but they need to participate. And they are participating this year. And that's a reason why some of the international markets, which are more overweight banks, are doing so well. So that is a good sign for market breadth to see banks participating. Now, one area that's not, it's healthcare. And healthcare, right now does not have the government behind it. They're looking at lowering their margins, and that's an area that is underweight for us as well. So we get into the sector breakdown. I think that's interesting to know. And again, with the infrastructure and industrials, that's another area. Those all have done exceptionally well. And again, we think some of that will continue as well.
Joe, can you talk a little bit about some specific names that we've recently shifted into
Yeah, so some of the old names that we've had, we've continued to be overweight industrials. That's the Eatons of the world. And these are the ones that are building, and we think that will continue. That's one area. And some of the higher profile names, when we look at nuclear, it's Constellation Energy. The ticker symbol is CG. We've held that for a couple of years, and it's done exceptionally well. Our number one position as a firm is Broadcom. That's a semiconductor. So you might hear a lot of talk about NVIDIA, but Broadcom has definitely been a beneficiary of that as well. And some of the more recent adds to more of our growth strategies have been Cameco, which is CCJ. They own, it's also the mining of uranium, but also they own Westinghouse. So what's interesting when you talk about nuclear power, this used to be a very dirty word. No one wanted to talk about nuclear power. And a couple of years ago, the administration made it more positive for nuclear companies to do business and putting a floor behind them, underneath them. And we think that's still in the early stages globally to continue to rise. So you are hearing about new plants in getting phased in and potentially being built. So we think that's a positive for that company. And then there's an ETF, which is called, that's Nuclear Energy and Power. The ticker symbol is NLR. And we own these in different strategies that we own. That kind of gets you a basket of some of the names we talked about. But again, it's utilities is the sector, and then driving down into some of the specific names. That is an area that I think will continue to do well, and that's an area that we have overweight.
Joe, I was recently on CNBC last week on Friday, and we touched on this. We're kind of at the edge of a biotech boom, unlike we've never seen before, and it's not just driven by biology, but by code now, and the AI is basically revolutionizing how we model diseases and predict drug interactions, and then even simulate clinical outcomes before a single trial is run. And you had just talked about Lilly, and Lilly fell out of favor. And one of the questions was, well, Lilly is sold off. But I'd like to talk a little bit more, Alex, first about the GLP drugs and how powerful they are from a market standpoint. We know that the GLP drugs are revolutionizing the way for people to handle diabetes and obviously weight loss, but it's not just for that. So, Alex, can you talk a little bit about
Yeah, I mean, look, 40% of Americans are obese. It is by far the most prevalent disease on earth. You look across the world, more than 1 billion people suffer from this. I mean, it causes trillions of dollars of economic damage. And ultimately, GLP-1 drugs are going to transform everything. And we might even see that positively impact the US budget deficit, right? America spends hundreds of billions of dollars on public health care. Well, a lot of that is treating obesity-related illnesses. So there's going to be ripple effects all across the world from this. I know, look, the market is very quick to jump on and off headlines, and retail investors, they jumped on the GLP-1 drugs, they got bored of it, they're now on to the next trade. But this is something that's going to take multiple years, and there's so much runway in this, perhaps more than any other medicine in history.
Yeah. So it's I don't know if Joe wants to add anything to
Yeah,
that.
I do. There's a
Go
couple
ahead,
of
Joe.
things. You did mention the cooling off. Eli Lilly, there's not many companies that are doubling revenue like they are.
Right.
And like Alex said, that's the kind of, when the sector's out of favor, that's one bright spot. But I do want everyone to know there's an insurance company called Aon, and they ran a report on their own employees. This is a multinational company, and they looked at the cost of improving these weight loss drugs to their employees. Now, it's expensive to do. And their study showed if doing it, you had a 10% reduction, the company did, in expenses. So overwhelmingly, it's positive, even if you're paying $1,000, per treatment, where the benefit on an economic standpoint is beneficial. And I think that's powerful to look at for these reasons. Now, we look at the secondary plays of this as well. And like we said with the junk food, but another interesting, and it may be tied to it, is people not drinking alcohol in the United States like they used to. Alcohol consumption is lower. And our last point is, again, a stock that we do own, Philip Morris and Altria. These are traditionally people think of cigarettes, but it's vaping. Vaping is growing globally at a massive growth rate. So, these are pockets that we look for. And again, it may not be the primary driver, but it's a secondary play. And I think that's important to know.
Yeah, nothing like going from healthcare and healthy lifestyles to vaping, Joe. That's a good segue. We should. Those are two opposite ends of the portfolio, but from a dividend play, it's Altria is outstanding. It's kind of a joke between all of us, but um, this emerging trend that we're seeing out there is obviously being driven by technology. And we have not avoided having the top names in the portfolio. We've benefited by a broadening of the market. And when we see a broadening of the market, that sends signals to us that there's a little bit more health in what the future looks like for us. Joe, you want to make some more comments on that as well?
Yeah, and it's when you look at, for us, our job is to manage assets and help our clients. And it's looking at them, for me, the investable world that's out there. And we can go domestic, international, other plays. And I think that's critical because so far this year, the international markets have done exceptionally well. And I think that, as we look at our portfolios, we have it. And that's part of why we outperformed in the first half of the year. So I do think when you're looking at your portfolios, know that you do own international, and we do think there's opportunities there, just like the two themes that we mentioned as well. So I know the headline noise is out there. We're not downplaying the risks, but there are opportunities that we see going forward, just like in any market.
We've been shifting a little bit of our energy towards health and longevity. We're actually introducing the idea of health being a new asset class for us and paying more close attention for not only you as our client, but in the directive that we send the messaging out for us. And we all know that it seems like we're probably going to live longer in our lifetime life cycles, but we need to be able to protect the assets that we have and grow them and for maybe even a longer period of time. We can talk about the success of the strategy asset manager's portfolio, but as Joe said, I would like to bring this back into play. If you look at the S&P 500 average return and then you compare it against what an active manager like Strategy Asset Managers has demonstrated this year, this is what is going to be a successful recipe for not outliving your money. We've done a very good job at delivering the shift from whatever sector we're going into or and the trends. And I just want to pat Joe and Alex on the back a little bit for that. During some very volatile times over the last several years, we've been able to navigate that with accurate information on interest rates, accurate information on the way that the trends are going from the sectors that we've held in the portfolios. So kudos to Joe and Alex for that and for the whole team. Alex, where do we see interest rates? Do we have you want to make a prediction on where you think the cuts are going to happen and when they're going to happen?
Yeah, so at this point, the market is expecting 2 interest rate cuts. So that's 0.5% by the end of the year. Now, there is a bit of strife happening, right? The present Fed chair, Jerome Powell, is very reluctant to cut rates. the administration very much wants him to cut rates. His term is going to expire next May. So he is going to be out, and most likely the administration is going to, wait for him to be out rather than fire him. What they are likely to do is announce his successor early. So they might announce his successor in October. And then what will happen is the market will be able to take information from that successor. And so that guy is probably going to say that, man or woman is going to say that he's expecting to do a lot of rate cuts in 2026. That will allow interest rates to fall all across. It will boost housing prices. So while I don't necessarily know that we'll get 2 cuts by year end, just because the current Fed is very reluctant to cut, I do think we're going to get a large number of cuts in 2026 as soon as the new regime is in place.
I've got some questions about earnings expectations, and at the beginning of the year, they were as high as 14%, and then they ratcheted down to 9%. And now they're back up to 12. So, talk a little bit about the expectation for earnings in the second half of the year.
Yeah, so as you mentioned, earnings are expected to grow double digits for the full year 2025. They're expected to grow double digits again next year. That's driven by the incredible strength of, the artificial intelligence investment super cycle. Those AI investments are just so incredibly positive for earnings. They're, likely to basically fuel profits for years to come if they end up being successful. So as long as, these AI investments keep happening, you can expect earnings to stay strong.
Let's talk a little bit about the investment in AI and the capital expenditure. If you can just explain that a little bit on why we're so optimistic about capital expenditures into the AI space, that would be
Yeah.
helpful.
Yeah, so the big 4 hyperscalers, they're planning to invest more than $1 trillion over the next few years, just an incredible number. And when they do that, companies all across the value chain profit. So companies like NVIDIA immediately profit, but the companies that are making the expenditures, they don't lose earnings, right? They're making an investment. So that just, it just juices earnings for the whole market, for the whole index. And as long as it continues, it'll be fantastic.
Sure, and then also, Joe, that it's a nice segue to kind of conclude on, with this huge capital expenditure into the AI space. They obviously need power, and we talked about Constellation Energy Group, Camco, why don't you close on the power issue again and what the theme is there?
Yeah, this has not been, first I want to say, this has not been an easy year to navigate. You've had quite a bit of uncertainties emerge, then dissolve, and then come back. Again, the best thing to do is sometimes not get caught up in those headlines. And that's when we go back to our fundamentals. And when we see money going into a certain sector, that's going to give you some stability. That's sometimes in the defense sector. That's done well. And again, like Tom said, you need a growing demand for electricity. It's that simple. So you want to invest in those types of investments. And that's what we've done. And again, that will continue. When you look at the data centers, think of the secondary plays. If you're getting more of these centers built, it helps the surrounding community. With lending, and again, deregulation with banks, that should allow lending to ease, which means, credit is more available. That helps both the consumers and potentially the small businesses. So these are the legs that we see that can happen if we get, more investments in the United States in some of the areas that we mentioned, not just from the direct play of that new facility being built, but the secondary plays. And that's how you get an economy going. That's something China would love to have. And again, I think when we look back on where we're investing right now and where our portfolios are, there are certain places, when to get a little bit more aggressive and when not to. And that's just the ebb and flows of the market. But this has been a very long year, and we're barely in July, excuse me. But again, I do see optimism in certain areas that we've mentioned. But again, it's more important sometimes what not to own. So that's the balanced approach Tom talked about with active management. And that's where we think we continue to see opportunities going forward, but also places where we don't want to be.
Yeah. So, just we'll try to conclude with just the key points and just review them. We mentioned the market rebound and the fundamentals and the stock market staging a V-shaped recovery from the sell-off earlier this year, and now we're reaching record highs. We talked about AI and stimulus, fueling growth. There's definitely favorable policy and a rate outlook that we think that rates are going to come down. That will help with the deficit and this passing of the big bill also gives some certainty for CEOs out there with risks and valuations. I talked about this last week on CNBC, and Joe was the person who was contributing a lot of this information to me. So I've got to give him credit. The market optimism may be overextended. We do have valuations that could be extended in certain areas, and there's obviously geopolitical tensions. But as we move into the third and fourth quarter, we are starting to get a clearer picture now that the bill has been passed. We know that interest rates will eventually come down, and the investment strategy for us is to stay focused on the active management and the disciplined approach on the fundamentals of the stocks that we own in the portfolio. And there's a lot to be positive about there, and we want to continue to manage the portfolios in that way and go towards these these opportunities in power and the technology sectors. It's there. Joe, do you want to say anything in closing?
Yeah, just my last comment. I know we live in California, and a number of the fires that have happened here, we think of the wars that are going on there and how unsettling that is. I'm not downplaying that, but I think of on an economic standpoint, you think of the rebuild, and you have to look forward and think of when we get this going, we get the homes being built. That's a massive stimulant for those local economies, but also for overall jobs growth. And again, lending and getting things built again, that's strong. And that's where we see things heading. I can't tell you when, but I hope sooner than later. And again, that's looking at a glass half full, half empty, but knowing that's what the market's going to key on. And we start seeing some of these issues get settled, and the rebuild is just something that you can see and feel. That is something that, again, can help this economy move forward.
Good. Okay, well, we actually can, if you want, Joe, we haven't done this in a long time. Do you want to open it up to any questions? Sometimes people want to throw something in there, but we're welcome to, you're welcome to ask a question. I don't see anything in the chat room.
Yeah, you can always send us an email, reach out to your advisor. We're more
Right.
than happy to answer any questions that you have.
Right. Well, we're very fortunate to be able to have the opportunity to speak to you. We don't take things for granted. We're grateful that we have clients and guests that would like to hear our opinion on things. We're not necessarily with the herd. And somebody just asked a question on Bitcoin and cryptocurrency and whether you're investing in this area or recommending to do so. And I'll leave it up to Alex on that and Joe. And then I'll make a comment as well. So can you speak to Bitcoin and crypto? I'll just say the direct answer is no, but I'll let Joe
Yeah, I mean,
talk
this
about
is
it.
we always go back to different cycles and seeing how investments can be made. And one of when we talk about cryptocurrency, the stable coins, also the technology behind it, for us, those are two different categories. I look at like a Visa, a payment processor, and how they get paid. It's not the technology they have, it's for doing each transaction. And it's the same thing when I look at transactions, who's going to be the person doing the transaction and what fee are they charging. So, for me, that I don't really see a big benefit there. But again, for the blockchain technology and the speed of moving money, that is something that does get factored in moving forward.
And just to jump in on that, stable coins are incredibly bullish for America. Whenever someone buys a stable coin, they're basically investing in treasury bills. And stable coin issuers are now one of the largest holders of treasury bills on earth. They're buying, trillions worth of this. And so as time goes on and stable coins become more and more adopted, that's going to create very, very significant demand for US treasuries. I know there's a lot of hysteria, who's going to buy treasuries? No one is, that's not true. This is a huge source of demand. So as Americans, we should all hope for stablecoin adoption to continue.
Right. I know this, that there will be a democratization of the, the cryptocurrencies eventually. And that the banks were ahead of this a long time ago with creating blockchain which is essentially, if you can picture train tracks, and then a lower train track below it on the rails, going in the same direction, but not regulated the same the way that money transfer is. But it is something that is happening, and there are people participating in this space, and we're not avoiding it. We just need to. We're going to continue to learn as much as we can, and go along with it. And then I don't see any other questions. Do you? No, I don't.
I think
So.
that's it.
Okay, well, listen, everybody, thank you very much on this hot day down in Miami for me. It's Wednesday, July 16th, 4:52 p.m. on the East Coast, and then Joe and Alex are on the West Coast. We will have another market update in September. And once again, please feel free to reach out to your advisor or to us directly if you have any questions. And we will have notes on the call as well that will be sent out to you. Have a good rest of the summer, everybody, and
Thank you.
we'll be signing off here. Thank you.